Imagine this for a second. The biggest hedge funds on Wall Street, the very institutions that have been trying for years to crush retail investors and bury AMC stock, are now showing cracks in their armor. They're losing grip, they're losing money. And for the first time in a long time, we can see the evidence piling up right in front of us. In today's video, we're going to break down how short sellers, including giants like Citadel, are struggling financially, how AMC continues to resist their pressure, and why all of this signals a turning tide in favor of retail investors. If you've been holding through the noise, this is exactly the kind of update you'll want to hear. Hey! Welcome to AMC Daily. If you are new to the channel, be sure to subscribe to the channel and turn on post notifications by hitting the bell so you never miss any of our uploads and also enter our giveaway. But everyone, remember, this is not a financial advice video. Let's start with the big picture. AMC closed the week at 280. Why is that important? Because the so-called max pain level, the point where the most options expire worthless, benefiting market makers and shorts, was set at 250s. For weeks, shorts have tried to drag AMC down to that number. They've spent enormous sums of money, time, and energy to force the price under that line. But once again, they failed. AMC didn't just close above max pain, it closed well above it. That tells us two things. First, retail momentum is holding stronger than the suppression tactics, and second, shorts are running out of the liquidity needed to keep this fight going. Here's why that matters. When a stock like AMC finishes above max pain, shorts lose money. It puts direct pressure on them financially. Every time they can't control the closing price, it signals that their old strategies of manipulation are weakening. And manipulation isn't free. It costs liquidity, capital, and leverage. So when they run out of those tools, what happens? They inch closer to margin calls. And margin calls mean exposure, forced covering, and eventually real price discovery for AMC. Now let's connect this to the numbers coming out of Citadel, one of the most infamous players in this entire saga. According to financial reports, Citadel Securities saw an 8% decline in net trading revenue in the second quarter, dropping to $2.39 billion, while net income fell a massive 23% to $922 million. Sure, those numbers still sound huge, but the trajectory is what matters. For a firm that thrives on exploiting short-term trades, swaps, and manipulative tactics, these losses tell a bigger story. The old playbook isn't working like it used to. And it doesn't stop there. Citadel has been openly fighting against new transparency rules like the Consolidated Audit Trail CAT system. Why? Because it shines light on their trading strategies. For years, their operations thrived in the shadows, hidden in dark pools and private deals. But as more transparency comes in, their edge weakens. They've also complained about competition from smaller trading firms running private rooms more effectively than Citadel can. Imagine that. The giant of Wall Street whining that smaller players are beating them at their own game. This is not the kind of behavior you see from a firm in control. This is behavior from a firm scrambling to hold on to its dominance. And then there's the real kicker. Total return swaps tied to AMC and GME. Back in January, AMC had $843 million worth of swaps. Fast forward to August, and that number ballooned to $1.1 billion. That's an increase of nearly $300 million in just 7 months. Think about that. If shorts had truly closed their positions like they claim, why are swaps increasing? Why are they still being used to hedge exposure? The answer is simple. They're still trapped. They're still entangled in this play. And instead of closing, they're layering on more risky financial instruments to kick the can further down the road. But swaps are not free. They carry massive risk and cost, and as we've seen with Citadel's revenue slump, those costs are catching up. We've also got to remember the history here. Citadel has claimed record profits multiple times in the past, but when it came time to pay investors, they had to take out loans with poor ratings, by the way. If they were truly rolling in cash, why borrow? Why not pay out directly from their supposed profits? The answer again is liquidity. Their balance sheet isn't as strong as they project publicly. Behind the curtain, they're far more vulnerable than they let on. Let's talk about what this all means for AMC holders. Every day, shorts are throwing money into the fight just to nudge AMC down by a penny or two. Look at the week's data. A 1-cent drop here, a 2-cent drop there. On Monday, they spent millions just to move AMC 7 cents. That's not a winning strategy. That's desperation. And desperation costs money, which accelerates their decline. Now, zooming out, what we're witnessing is the gradual erosion of short sellers' power. It's not going to happen overnight, but it's a process. Each failed attempt to control AMC's price chips away at their capital. Each quarter of declining revenue weakens their financial position. Each increase in swaps reveals just how trapped they still are. Step by step, brick by brick, the wall they've built around AMC is starting to collapse. And here's where it gets interesting. As shorts lose money and liquidity dries up, we approach real price discovery, the moment when AMC trades based on fundamentals, demand, and sentiment, not manipulation. That's also the moment when the potential for a short squeeze becomes very real. Shorts know this, which is why their top priority now is to scare retail into selling early. They want you out of the play before the big move. They want you discouraged by the slow grind, the negative headlines, the endless attacks on AMC's fundamentals. Because the fewer retail investors left holding, the less they'll have to pay when the squeeze comes. Even AMC's own leadership has hinted at this. CEO Adam Aron has made it clear he wants to retire as a winner. That means steering the company through the storm and into profitability, which directly benefits shareholders who stay the course. The longer you zoom out, the clearer the trend becomes. Retail holding strong, shorts slowly bleeding capital, and AMC edging closer to its moment of truth. So, what's the takeaway from all of this? Shorts are losing, Citadel is showing weakness, swaps are ballooning, and AMC is closing above max pain levels despite all their efforts. That's not the sign of a healthy short thesis. That's the sign of a strategy falling apart. And as history has shown us, when the cracks start appearing, it's only a matter of time before the dam breaks. Guys, that's all we have for you today. What is your opinion about AMC stock? Get involved and let us know in the comments down below. Thank you for watching.